Stop, do not do what they want you to do right now. They want you to see that headline, silver futures down 8%, gold down 5%, South Korea's exchange halted by a circuit breaker, and they want you to believe that everything you built this year is disintegrating. I know what it felt like. I know what your portfolio looked like when Tuesday, March 3rd printed silver futures at $81.23. I know the message threads that exploded across every forum, every group, every channel. The momentum trade is over. They are wrong. It is Wednesday, March 4th, 2026, and what you witnessed was not the death of the bull market. What you witnessed was the pre-crash anatomy of a momentum unwind. And understanding every layer of it is the difference between the investor who survives this and the investor who hands their position to someone who does. Ladies and gentlemen, silver analyst here. Silver is heating up, and this move could surprise the market. Let's break down what's happening right now. If you want clear and powerful silver market updates, make sure to like, subscribe, and follow Alex Carter Reports for the latest analysis. On March 3, 2026, the financial press delivered one of the most telling headlines of the entire year. Reports circulating across major financial news outlets described the simultaneous collapse of the three biggest momentum trades of 2026, gold, silver, and South Korean equities, all down big amid fears that the Iran conflict could persist far longer than markets had originally priced. According to market data published that day, silver futures fell more than 8% to $81.23 per ounce. Spot gold declined more than 5% to $5,041.81, while gold futures fell 5% to $5,049. The iShares MSCI South Korea ETF collapsed 14% in a single session, though it remains nearly 30% higher year-to-date. And the cause assigned to all three simultaneous crashes was identical. The war in Iran is taking longer to resolve than investors had assumed. Now here is what that narrative gets catastrophically wrong. It labeled three different asset classes, a monetary safe haven metal, an industrial and monetary hybrid metal, and a semiconductor-driven equity market, as the same trade. And it called simultaneous decline a confirmation that the trade is over. That is not analysis, that is pattern recognition applied without mechanical understanding. Let us look at the technical anatomy of Tuesday's silver move with precision. Sources confirm silver followed the broader precious metals decline with amplified force, dropping from Monday's $90 per ounce level down to approximately $79.52 at one point during Tuesday trading. That is a move of more than 10% in under 24 hours. The 52-week range for silver futures spans from approximately $29 at the low end to $121.78 at the January 29th all-time high. At $81 on Tuesday, silver sits $52 above its 52-week floor, a position of structural strength that a single-day 8% decline cannot erase. The left shoulder formation of the broader right shoulder compression pattern sits in the low 80s. The head was the all-time high of $121.66 reached on January 29th. The current price oscillation from Monday's $96.40 high through Tuesday's $78.13 futures floor represents the volatile compression arc of the right shoulder assembly. The neckline breakout that confirms the entire bullish pattern sits in the $92 to $93 zone. Every violent flush toward the low 80s is not a pattern failure. It is right shoulder compression loading energy into the coil. The anatomy of the pattern requires exactly this kind of fear to flush out weak-handed paper holders. Without their forced exit, the breakout lacks the fuel it needs to sustain itself. And critically, despite everything that happened on Tuesday, silver remains higher by 15% year-to-date. Gold remains up more than 16% year-to-date. The South Korea ETF remains nearly 30% higher year-to-date. These trades did not break. They breathed. And breathing is not dying. The pattern that generated 15% returns in 2 months does not collapse in one afternoon. What collapses in one afternoon is leveraged paper exposure built on top of the structure. The structure itself held at $81.23, and market trackers confirm the metal was already recovering toward $85 by Wednesday morning. Now let us dig into the precise mechanical sequence that generated Tuesday's crash, because understanding the sequence in its exact order is the intelligence that tells you when the next one is coming, and more importantly, when it ends. Step 1 in the sequence was manufacturing input cost data for February, published Monday, March 2nd. According to market analysis, that reading came in at 70.5, obliterating the consensus estimate of 59.5 and the prior reading of 59.0. This is an inflation acceleration signal of the highest order. Factory-level input cost pressures are building at the fastest rate in months, and that reading landed before the full transmission of oil and energy cost increases from the Middle East conflict had even reached the industrial pricing pipeline. In other words, the worst was not yet in the data when the data already shocked. Step 2 was the European natural gas explosion. According to reports from analysts tracking the conflict's energy impact, Where European natural gas futures detonated more than 70% across 2 trading sessions following Iran's targeting of Qatar's Ras Laffan LNG processing facility. European natural gas reached a 3-year high per market data trackers. This is not a localized price signal. Natural gas prices feed directly into electricity costs, fertilizer production, chemical manufacturing, and industrial output costs across an entire continent. The transmission from natural gas to broader inflation is measured in weeks, not months. Step 3 was the oil surge. Reports confirm Brent crude topped $84 per barrel and WTI crude jumped above $77 on Tuesday, driven by fears about extended Middle East conflict duration. Sources note that an $18 war risk premium has already been embedded into crude price models. Analysts warn oil could reach $100 if the Strait of Hormuz disruption persists beyond the current timeline. These 3 inputs, scorching factory prices, European energy explosion, oil surge, landed in the market simultaneously. The combined inflationary signal was impossible for the Federal Reserve rate cut narrative to survive intact. According to market data trackers, the CME FedWatch tool registered June hold probability jumping to nearly 60%, up from below 45% the prior week. When the probability of rate cuts collapses, the primary pillar of the precious metals thesis, that declining real yields would sustain momentum, gets repriced in real time. When that pillar gets repriced, the dollar wins the safe haven competition against both gold and silver. Sources confirm that a surging dollar makes dollar-priced commodities mechanically more expensive for every buyer holding a non-dollar currency, reducing purchasing demand from Asian and European buyers instantaneously. When purchasing demand retreats from leveraged markets, stop losses chain react, and the cascade amplifies the initial move far beyond what fundamentals justify. Reports citing multiple analysts confirm spot gold fell as much as 6% to nearly $5,018 per ounce, a dramatic reversal from the 1-month high above $5,400 set the previous session. Silver dropped almost 12% to under $80 at the session low, per those same reports. These are not the moves of a market with broken underlying structure. These are the moves of a market that was over-leveraged at the top and performing a rapid mechanical flush. The distinction is critical. A structural breakdown requires selling everything and waiting for new lows. A mechanical flush requires knowing where the floor is and positioning accordingly. The floor was $78 to $81. It held. The recovery is already underway. The most revealing phrase in any financial news coverage of Tuesday's crash was not a price level or a percentage. It was a behavioral description. Reports noted that investors appeared indiscriminate in dumping assets they feared may have gone too far, too fast. Indiscriminate. That single word is the entire story. Not rational, not fundamental, not structural, indiscriminate. Capital leaving every overcrowded trade simultaneously, not because each trade's underlying thesis collapsed, but because all of them were held by the same over-leveraged investor base that needed to reduce risk exposure at precisely the same time. This is the mechanics of a correlated unwind. When the same pool of capital holds silver positions, gold positions, and Korean semiconductor ETF positions simultaneously, treating all 3 as diversifiers against US large-cap tech, a single macro shock creates a single decision: reduce everything. Not reduce silver because silver is oversupplied. Not reduce South Korea because Samsung's chips are suddenly worthless. Reduce everything because the inflation repricing shock demanded margin be raised across the board, and the path of least resistance was selling the year's largest winners. The year-to-date performance context makes this structural reading undeniable. Reports confirm the S&P 500 climbed 64% cumulatively over the past 3 years, but sits down 1% in 2026. Silver is up 15% year-to-date. Gold is up 16% year-to-date. South Korea's ETF is up nearly 30% year-to-date. These 3 trades generated the most concentrated profits in the institutional world in the first 2 months of 2026. When a single macro shock forces large-scale deleveraging, the most profitable positions get harvested first, not because they are wrong, but because they have the most unrealized cushion to sell through. The minor bloodbath confirms this reading with striking precision. As per reports from Tuesday's session, Hycroft Mining fell 17%, Hecla Mining fell 15%, Core Mining fell 13%, Galliano Gold fell 13%, and Anglo Gold Ashanti fell 12% in a single trading day. These are not companies with broken economics. Analysts note Hecla Mining's all-in sustaining cost sits at approximately $11 per ounce of silver after byproduct credits. A company that produces silver at $11 per ounce and sees its stock fall 15% when silver trades at $81 still carries a $70 margin per ounce. The stock sold off because leveraged investors needed cash, not because the company's economics became unprofitable. There is a categorical difference between those 2 events. The broader market backdrop confirms the correlated unwind. Reading further, sources report that South Korea's Kaspi triggered its circuit breaker during Wednesday's session as panic selling extended into a second day. The Korea Exchange temporarily halted trading on the index. The tech-heavy Kosdaq fell 14%. Samsung Electronics dropped 11.7%. SK Hynix lost 9.6%. Global funds offloaded more than $3 billion of Korean equities in a single session per market data. But simultaneously, South Korean defense stocks surged. Sources confirm an air defense systems maker soared 30%, and the country's largest defense manufacturer gained 22%. The same geopolitical shock that is crushing semiconductor momentum is printing new highs in defense names. Capital is not fleeing risk entirely. It is rotating between risk types, and physical silver is one of the destinations that rotation eventually finds. Now let us address the most dangerous idea circulating across every forum and financial news outlet right now. The argument that Tuesday's simultaneous crash of silver, gold, and South Korean equities proves that geopolitical risk no longer drives precious metals higher, that the safe haven narrative is permanently broken. The argument runs as follows. The Iran conflict is in its fourth day. The Strait of Hormuz is disrupted. Drones struck a United States embassy compound. Oil has surged 14% in 2 sessions. And yet gold and silver fell. Therefore, the safe haven function of precious metals is structurally destroyed. Let us dismantle this argument with precision. It commits one of the most elementary errors in commodity market analysis. It confuses the short-term paper market response with the long-term structural response. They are different instruments operating on different timescales with different participants. The short-term paper market, futures contracts, leveraged ETF positions, momentum speculator books reacts to inflation repricing and margin calls on a 24 to 48-hour clock. The medium-term physical market, industrial procurement contracts, ETF physical allocation, central bank accumulation, retail stacker purchases, operates on a 1 to 12-month clock. On Tuesday, the paper market cleared. Leverage positions met margin calls. The tourist liquidated. By Wednesday morning, silver was already recovering toward $85. The paper panic lasted approximately 18 hours. Now compare this to the asset class that most loudly markets itself as a monetary safe haven competitor to silver. Reports confirm Bitcoin was trading around $68,487 on Tuesday, down only about 1% on the day. The community interpreted this as stability. But 1% down in a single session of active geopolitical crisis is not stability for an asset built on a safe haven narrative. It is fragility on a delayed timer. Because in the months preceding Tuesday's crash, community trackers confirmed Bitcoin had already shed more than 25% from its peak, while silver was building from $60 toward $96. When the crisis hit Tuesday, Robinhood, the retail sentiment and crypto platform, fell 3% per market reports, directly tied to reduced crypto trading volumes and a broader risk-off retreat across digital assets. The structural math of the comparison reveals the real story. Silver remains higher by 15% year-to-date, even after Tuesday's 8% crash. That is the net result of a metal that rose dramatically, absorbed the largest single-session cascade since the war shock, and still sits dramatically above its year-opening price. Bitcoin's behavior in the same environment confirms what the on-chain data and correlation studies have indicated for months. When genuine geopolitical macro stress hits, Bitcoin moves with risk assets, not against them. The structural bull case for silver requires answering one question no credible bear has answered cleanly. If Tuesday's crash was structural and not mechanical, why did mining companies with $11 all-in sustaining costs fall 15%, while silver traded at $81? Those companies are generating $70 per ounce margins at $81 silver. Their stocks fell because leveraged holders needed liquidity, not because the companies became unprofitable. That is the definition of a mechanical flush, not a structural breakdown. And mechanical flushes create exactly the reload window that diamond hands have been waiting for. The deficit is 67 million ounces in 2026. The floor at 78 to 81 absorbed the paper wave. The structure held. Let us now construct the pre-crash anatomy framework, the map that tells you what the warning signals were, what you should watch for before the next episode, and what the tactical response to Tuesday's type of event looks like. The pre-crash warning architecture. What Tuesday was telling you. Every pre-crash setup in a leveraged commodity market leaves breadcrumbs. Tuesday, March 3rd left 4 of them in plain view in the 48 hours before the cascade. Warning 1, silver hit $96.40 on Monday, March 2nd, the highest print in weeks. That level coincided with the approach of the right shoulder neckline resistance zone at $92 to $93. When price overshoots a key resistance zone in a momentum-driven market, the reversal is proportional to the overshoot. The higher and faster the overshoot, the sharper the reversal. Silver's Monday spike to 96 followed by Tuesday's flush to 78 on futures is the textbook anatomy of that overshoot mechanism. Warning 2, the factory inflation data. Monday morning delivered a manufacturing input cost reading of 70.5 versus a 59.5 consensus. An 11-point overshoot in input cost inflation is a regime signal, not a routine data miss. Any holder of precious metals on Monday morning who understood that this reading would collapse Fed cut odds and strengthen the dollar had a narrow decision window before the market fully repriced. Warning 3, the energy cascade. European natural gas did not explode 70% in silence. The Iran strike on Qatar's LNG facility happened in a publicly reported active conflict. Anyone tracking the geographic expansion of the conflict toward critical energy infrastructure had the intelligence needed to understand that energy inflation was about to transmit into the broader commodity complex, and energy inflation is a dollar-strengthening signal. Warning 4, the minor divergence on Monday. When an underlying metal surges to $96 but mining stocks are not keeping pace or are showing relative underperformance, that is an institutional signal that desks are reducing rather than adding exposure at the top. The miners often lead the metal at turning points. Their reluctance to confirm Monday's silver spike carried the quiet intelligence that the move had overextended its institutional support. The tactical response matrix level 1, the floor zone $78 to $83. Sources confirmed Tuesday's session low traded to $78.13 on silver futures before recovering. The $78 to $83 band is the structural defense zone where physical demand absorbs paper selling. A daily close below 78 opens the secondary support band at 74 to 76. A daily close above 83 confirms the recovery arc has real velocity. Level 2, the recovery confirmation $85 to $88. Market trackers confirm silver already trading near $85.64 on Wednesday morning. A close above 87 stabilizes sentiment. This is the institutional reload zone, where buy orders placed during the flush begin to execute. Level 3, the re-engagement gate, $90. A daily close above 90 in the context of softening labor data. ADP today, NFP Friday, signals momentum resumption. Above 90, the neckline breakout at 92 to 93 becomes the primary target. The measured move from that breakout projects toward $100 and beyond. The pre-crash prediction. What this setup signals next. The pre-crash anatomy is now visible in retrospect. The overshoot at 96 was the ignition, the inflation reprice was the accelerant. The margin cascade was the mechanism. The floor at 78 to 81 was the defense line. All four stages played out in textbook sequence across 48 hours. The next leg requires a softening dollar or a conflict duration signal. Either one delivers silver back toward 90. Both together deliver it through the neckline. Tell us below, do you expect ADP to miss today? Drop your read in the comments. Stay stacked, stay sharp. Silver analyst here. See you at the next level. That's it for today's silver update. The market is setting up for a potential big move, so stay alert and stay prepared. If you found this analysis helpful, don't forget to like the video, subscribe to the channel, and turn on notifications so you never miss an update. This is Alex Carter Reports, bringing you clarity in every market move. See you in the next one.